Hey everyone, the stock market can feel pretty chaotic, right? But what if I told you it's all just a game? Market ga kale, a game that has its own hidden set of rules. Today, we're going to learn those rules so you can start playing a whole lot smarter. So, is the stock market really a game? Well, in a way, yeah, it is. And just like any game, if you know the rules, you've got a serious edge. A stock's price doesn't just move around randomly, it's actually following patterns. Our job today is to break down those patterns in the simplest way possible. To get a handle on this, I want you to imagine a stock's price is a bouncing ball inside a room. Sometimes that ball bounces high, sometimes it stays low. This simple idea, it's the key to unlocking three of the most powerful concepts in all of trading: support, resistance, and trend lines. So let's build our room. First things first, every room needs a floor, right? In our market game, this floor, or zamin, is what we call support. Think of it as an invisible safety net that often stops a price from falling any further down. So what does that actually mean? Well, support is simply a price level where the buyers decide to jump in and overpower the sellers. The ball hits this floor, and the buying pressure is so strong that it has nowhere to go but right back up. It's really a psychological line in the sand. Let's put a number on it. Say a stock keeps dropping to around 100 rupees, but every single time it gets there, it bounces back up. Well, that 100 rupee level has now become a really strong support. Why? Because traders look at that price and see a bargain. It's the Sasta zone. The demand just overwhelms the supply and boom, the ball bounces. Okay, so we've got our floor. But what goes up? Well, it usually hits a ceiling, right? In our game, this ceiling, or chot, is what traders call resistance. It's the level that often stops a rising price dead in its tracks. Resistance is the perfect opposite of support. It's that price level where the sellers finally take back control. The mood shifts, and people start thinking, you know what, this stock is getting a little too expensive for me. The selling pressure gets stronger than the buying pressure, and just like that, the ball hits the ceiling and falls back down. Let's go back to our stock. Imagine it repeatedly climbs up to 150 rupees, but it just can't seem to push any higher. It hits 150 and drops. That level is now its resistance. Traders see it as expensive, the manga zone, a great price to sell and cash in on their profits, which creates a wave of supply that pushes the price right back down. Now, this is where it all comes together so perfectly. You can see how these two ideas are just mirror images of each other. Support is the floor. Buyers are in charge because they think the stock is cheap. Resistance is the ceiling. Sellers are in charge because they think it's expensive. But look at that last row. Role reversal. This is so important. If our bouncing ball suddenly smashes right through the ceiling, guess what? That old ceiling can become the brand new floor. And the same thing happens in reverse. All right, a floor and a ceiling in a flat room, that makes sense. But what happens if the whole room is tilted? This is where trend lines come into play. They show us the market's overall direction, or disha. And that tilted room idea perfectly explains the three main states of the market. An uptrend, that's just a room tilted upwards. The price keeps hitting a rising floor and bouncing higher and higher. A downtrend is the opposite, a room tilted downwards, with the price constantly hitting a falling ceiling and moving lower. And a sideways trend, well, that's just our original flat room, where the price is stuck, just bouncing between a fixed floor and ceiling. So we understand the room, the ball, the floor, and the ceiling. But how does any of this actually help us trade? Let's start putting these concepts together and look at some real tips for any trader out there. Okay, here are a few things that experienced traders always keep in mind. First off, support and resistance aren't these perfect razor-thin lines. They're more like zones or areas. Now, when the price smashes clean through one of these zones, that's called a breakout, and it can signal a huge move is coming. But, and this is a big but, you have to watch out for the false breakout. It's a sneaky little move designed to trap traders who jump in too early. That's why confirmation is your absolute best friend. So, how do you actually trade smarter with this stuff? Well, look for levels that have been tested over and over again. Those are the really strong ones. When you draw your trend lines, use longer-term charts, like the daily or weekly, to get a more reliable picture. And most importantly, never, ever trust just one signal by itself. You should always look for confirmation from other tools, like trading volume or the RSI. And the golden rule through all of this is simple. Don't jump the gun. Wait for the market to prove that you're right. Which brings us to our final question. The price is right there, pushing against a huge resistance level. It's about to break out. The temptation to just dive in is massive. So what do? Do you trade it instantly, hoping to catch the entire move from the very beginning? Or do you wait for confirmation, maybe missing the first little part of the rally, but saving yourself from a potentially deadly trap? The answer to that question, well, that's what will define your journey as a trader. Something to think about. Thanks for tuning in.